Markets just had their worst week in a year, and equities are now sitting at critical support levels. So, what I thought we would do today is walk through a number of different signals that I look at and tell you what I'm thinking going forward. And many of you who've been with us for a long time, I did something similar back in August. And if you want to look back at that episode, it was titled The Anatomy of a Trade. So I thought what we'd do is we would walk through some of those same signals we looked at back then, which were very helpful to us then, to see where we're at now. Now, for those who are longtime followers and listeners, you can see I'm not in my usual setup here. I'm over at my friend Hugh's house for his birthday. So this is going to be a relatively short episode, but I did want to come to you and give you an update on what I'm thinking. So what I'm going to do here is I'm just going to share my screen, and I'm literally just going to walk you through everything I just looked at myself and tell you my thoughts on them. And then we can kind of wrap it up with a potential where do we go from here. So let me figure out if I can share my screen here. One second, one second, one second. Okay, so you should be able to see my Bloomberg screen now. And what I'm going to do is walk you through some of the different charts that I am seeing, and tell you kind of what I think that what I think we're seeing. And so the first chart here is the VIX. Now this chart goes back a little bit over a year, and as we've seen over the last year, there's been several episodes, especially last summer, where the VIX, had that huge spike it actually went up to about 60 or 70 intraday. Um, but typically the vol spikes that we have seen have lasted a day or two, and then they come back, down pretty quickly. They last, and then they come back down. What's pretty interesting this time is for the last 2 weeks, the vol has just been rising pretty steadily. There hasn't been a really big spike, and there hasn't been a really big retracement. And so during that time, markets have sold off. And the question now is, where do we go from here? Are we going to have another big drawdown like we typically have seen, which seems a resumption of risk on? Or does this kind of jump higher, potentially even up into the 30s, before we see a meaningful correction in volatility? Well, the first thing, let's look at the Dow Jones. So this is the Dow. This is the chart of the Dow. It goes back about a year. And this chart shows several things. So the top line up here, the white, this is the Dow. The pink, the green, and the yellow are the different moving averages. It's the 50-day, 100-day, and 200-day moving average. You can see the Dow closed just above the 200-day moving average. So that's kind of a critical support level. What we see in the middle here is relative strength. And you've heard me tell many times, when relative strength gets really high, that's an indicator. And when it gets really low, it's an indicator. You can see back here in July, relative strength was super high. The stochastics, which is kind of a measure of momentum, were very high. And that's when we saw that really hard drawdown in risk assets. Now, since then, we've kind of had a number of rallies and pullbacks along the way. But really, at the end of January, we were at another kind of peak in relative strength. Stochastics were starting to roll over, and then that's what we've seen in February as the market sell off. This is starting to get pretty low from a stochastics level. Relative strength is pretty kind of in no man's land, and we're still above the 200-day moving average. So things don't look as serious in the Dow. But if we go to the S&P 500, same chart, same thing. It actually closed right at the 200-day moving average. And again, if we go back here and we look in the summer, we had a peak in the middle of July. Relative strength was kind of at extreme levels. Stochastics were at extreme levels, and that's when we got the drawdown. Now we got kind of we didn't get quite as severe here in February, but we've had a really dramatic drawdown, and you can see relative strength is still not super low, but it's fallen a lot, and stochastics have gotten very weak. So momentum has gotten very weak, and we're kind of sitting right at critical level on the S&P 500. If we move over to the NASDAQ, it's even more severe. The NASDAQ, it actually closed below the 200-day moving average, not by much, but just below it. Its relative strength is even lower. Still not quite extremely low, but it's fallen a lot, and the stochastics are extremely low. So that's just a reflection of markets having sold off quite a bit. The interesting thing is if we were to switch this chart and go to a weekly chart, which I'll do here, um, we're kind of right at the 50-week moving average, and that kind of goes across for all of them. And you can see that relative strength has fallen off, but it's still kind of in no man's land, not dramatically low, but it's headed in that direction. One thing that's kind of surprising to me is if we look at the put call ratio. The put call ratio hasn't moved a whole lot. I would have expected with this market action that there would have been a huge resurgence of put buying compared to call buying, but it just really hasn't shown up yet. If we look at this chart, the lower it goes, the more risk on people are. The higher it goes, the less risk on people are. As an example, at the beginning of 2024, if you remember, everybody was very bearish, and we're buying all kinds of puts, and then the market rallied huge at the beginning of 2024. So I would have expected the put call ratio to be kind of up in this range, to be quite honest. And so the fact that it here, it kind of tells me that there may be still some more room to the downside. If relative strength of all the indexes was even lower than it is now, and if the put call ratio was really high, that would give me an indication that perhaps we're pretty close to at least a short-term bottom. But that's really just not showing up in the data here. The other thing is what my base case, and you've probably heard me say this before, my base case for 2025 is 2022. And my base case is that we don't have a recession, or if we do have a recession, it will be a V-shaped recession, again, very similar to 2022. Now, I can obviously be wrong, and I reserve the right to change my mind, but that's my base case. Part of the reason I think that is because I think with Trump coming in and kind of making a wholesale change in the way the United States done business, it's kind of a whole new regime. And I equate that to 2022 because in 2022, the Fed went on its major rate hiking cycle, which was kind of a whole new regime. There's many people who'd worked for years on Wall Street and had never seen a really strong rate hiking cycle. Nobody knew where the terminal rate was going to be. Nobody knew if the Fed was going to stay the course or if they were going to stop. And all that uncertainty led to big downside in the market over the first 6 to 9 months. But if we look at it, this is the beginning of 2022. We had like a 10% drawdown, had a 5% rally, another 7 or 8% drawdown, 7 or 8% rally, 15% drawdown, 5% rally, and another 15% drawdown. Huge rally, and then a huge drawdown. So that's kind of what I expect for the next 6 months in the markets this year, because it's not going to go in a straight line. Things will get oversold. There will be bounces. The biggest bounces and the biggest daily moves often take place in either downward markets or bear markets. So I have no doubt there's going to be some furious rallies along the way. But I do think that we probably, going back to these other charts, I think we probably do break the 200-day moving average here. I think we probably break the 200-day moving average on this S&P, and I think we go further down on the NASDAQ. Let me move this back to a daily chart. And so then it becomes a question, well, where could we fall to, right? Well, I think going back to, where we were last fall, August, September timeframe would be easily possible. But again, we're kind of at critical support levels here. Wouldn't surprise me at all if we get a short-term bounce before ultimately breaking that. But I actually do think, so maybe next week, maybe we're down on Monday just because it's a Monday. Maybe we bounce on Tuesday or Wednesday, Thursday, and then kind of roll over into the following week and break the 200-day moving average. Again, I don't know for sure how this is going to happen. That we have had puts on. I've actually been rolling those down. So we've been taking the profits as they've been going down. And one of the things I've started doing is, because these markets are not nearly as strong as they were, and they've gotten dramatically weaker than they were, is I've started looking, well, where else can we put exposure on to the downside that isn't already, down significantly? And, I'll tell you, one of the things that this is not a recommendation. I'm not telling you guys should be doing this, but one of the things we've been doing is we've been started to buy some puts on the Hang Seng, which is the Hong Kong equity index, because it's still at its all-time high, or at its recent high, and its relative strength is still very high, but starting to roll over, and its stochastics are starting to roll over. So I feel I like starting to get exposure here. You don't want to short a chart that's going up, but once it starts to come down, that's a potential time to put a trade on. So we've started, not a lot, but we've started to do it on the Hang Seng, and then also similar thing on the DAX, the German index. And I'll go over why I think that's going to be a problem. But it was at its high. It's now kind of started to roll over a bit. Its relative strength was really high a couple of weeks ago, and now it's started to break down. So I think the DAX could be on the verge of breaking down. So we've started to migrate some exposure there. Part of the reason is, a lot of people have cited higher U.S. interest rates as a reason they believe the U.S. is going to go into a recession. And while that's certainly possible, what's been happening in Europe over the last week or 2 weeks, as Trump has started changing these multilateral agreements and has told Europe that they need to start paying for more of their own defense and that they need to contribute more to NATO, and the U.S. isn't just going to do it all alone anymore, that they're going to have to pick up the slack. And so they're going to have to spend a lot of money to do that. And as a result, the French rates, look at French interest rates. They've spiked in the last week. Same thing for German interest rates. They've spiked. Now, ultimately, probably and that's why the dollar has been weak over the last couple of weeks, is because higher rates pull capital into those currencies. So the euro has been getting stronger, I believe, as a result of these stronger rates in Europe. But in the same way that many people think that higher rates in the U.S. has the potential to cause the recession, I think the same thing is for Europe. And ultimately, while the euro has been strengthening on the back of this, when the ECB is going to have to start doing QE or monetizing the debt in order to keep these rates under control, because they're going to have to spend even more than they've been spending, I think ultimately that will be bad for the euro. But in the meantime, as the euro has been rallying, the dollar had one of its worst weeks in a year or two, and it actually broke the 200-day moving average. So you can see, it's come down a lot in the last couple of weeks, which is pretty interesting to see the risk off happening with the dollar falling. That's pretty unusual. I would imagine if risk off continues lower, then we're going to see a rally in the dollar. But as of now, its relative strength isn't super low, but it's low. But its stochastics are just extremely low. So probably going to get a bounce in the dollar, at least short term. And then we'll see whether it goes lower into the summer or not. This is the euro. It's just kind of the opposite. You can see its relative strength is starting to get very high. Its stochastics are high, but not super high. And then I know you guys like it when I talk about the positioning on gold and silver. So this is the commercial short position versus the gold price. So gold pulled back a little bit last week, but not a lot. It's still at $2,900. What's interesting is the commercial short position has stayed pretty steady for the last 6 months. It'll rally a little bit and fall, rally, fall, rally. So I'm really interested to see whether the price continues higher and the short position gets bigger, or whether we start to see kind of a migration back to the price coming down a little bit and the short position being covered. Silver, you can see, excuse me, silver, the short position, got covered a lot late last year, early part of this year, but now it's been building up again over the last month. So we're gonna have to continue to follow that as well. I think this is interesting. This is copper. So copper, remember we highlighted this last year. We showed when the price was really high and the commercial short position was really huge, we said that is an indication that the price of copper is going to come down. That's how we always see it. And that's exactly what happened. We had a 20% pull down in copper and the short position got bigger. But what we've been seeing the last probably 3 or 4 months is that the price has now been rebounding, but the short position has been getting smaller, and if we're going into this big global recession, you wouldn't necessarily expect to see copper doing well, but copper has been holding up pretty well. That could be either a sign of the fact that they think that China is getting ready to stimulate more, or it could just be due to geopolitical factors, military potential conflicts and, critical industries and resources. Prices could be constrained. So copper is pretty interesting right now. One of the other things that I look at, let me see if I can, I'm going to have to stop sharing this screen. And then how do I go back to, hold on, let me get back. Let me find another screen to share, because this is something else that I look at and I've shared with you guys before. Hold on one second. Where's it at? Tab. Oh, you know what? It's not letting me do it, unfortunately. Sorry. Well, what it was is I've shown you the screen that shows the daily sentiment of different asset prices. And what's pretty interesting is, you know, obviously the sentiment on equities has come down a lot. Sentiment on the dollar has come down a lot. It's rallied on, sentiment has rallied on copper. Sentiment has rallied on the euro, but nothing is in extreme territory. Nothing is extremely oversold and nothing is extremely high. And so that, because nothing is completely oversold yet, because, you know, the put call ratio hasn't gone crazy, because we haven't really seen a spike in the VIX, we've only seen kind of a very steady rise in the VIX, and because we're still at support on a number of the equity indices, my guess is that we probably have further to go. I think we're probably going to get a short-term buying opportunity sometime in the next couple weeks, 2 or 3 weeks, but I don't necessarily think that we're there yet. Again, my guess is maybe we're down on Monday, we bounce for a few days and then roll over again. I do think that those 200-day moving averages will be taken out. But then I think it's going to be like 2022. I think we're going to see a number of rallies and we're going to see a number of pullbacks. But ultimately, I think the word for 2025, and I've said this before, I think the two words for 2025 are volatility and realpolitik. You know, it's kind of a brave new world with Trump coming in and making all kinds of comments every day. You just don't know what you're going to get. And all the uncertainty surrounding all of this stuff, I think, means volatility and probably lower risk assets into the second half of the year. Okay, that's it. Hope you guys have a great weekend. Thanks for tuning in, and we'll talk to you again next week. Bye-bye.